Good morning, everybody. Happy New Year. Welcome to Phoenix Trading Strategies, where strategic knowledge and information that allows you to trade successfully. Today is January 4th, 2016. It is 9:02 a.m. Eastern Time. For those of you that are here for the first time, we want to welcome you. And for those of you that are back, we want to welcome you back. Last year was a very interesting year. We had great success, and this year looks to be even much better from what I'm seeing in the markets. Always the first week of trading defines how much opportunity there will be in the markets, and whether you're ready to take advantage or not. That's the other question. So my job is to educate you and to show you that technology can work in your favor, the right technology. So let's begin. Let's go to the disclaimer and go from there. Disclaimer. Future stocks and spot currency trading have large potential rewards, but also large potential risk. You must be aware of the risk and be willing to accept them in order to invest in future stocks and forex markets. Don't trade with money you can't afford to lose. This website is neither a solicitation nor an offer to buy, sell future stocks or forex. No representation is being made that any account will or is likely to achieve profits or losses similar to those discussed on this website. Past performance of indicators or methodology are not necessarily indicative of future results. Being that said and done, let's go back to the home page. So for those of you that are new, if you haven't had a chance to take a look at our website, please do so. You'll find that our whole philosophy of trading is based off of 4 components that make up volume. Volume price analysis, volume spread analysis, volume divergence, and order flow, the actual footprint of the trade. We've been able to create indicators and a strategy that encompasses the whole thought process of volume in the market by giving you a visual and numerical values that can add up to opportunity, to a trade. Now the question is whether you can interpret how to find that trade. And we think that we've made it a little simpler than most. So we're going to go to the charts very soon. So you can take a look. Give me 1 second. Let's pull that up. Chart. What happened? Oh, there it is. So let's take a look at this. So first things first, before we go to the indicators, I normally trade off of 1 or 2 charts, and I have the market analyzer, and I have all the instruments that I trade. Now, by putting all the instruments that I trade futures and I trade forex. Primarily forex. The futures, depending on if there's any trade opportunities. In this case, there was at the beginning of the day, the trading day. Yesterday, you still had, let me see, 2, 3, 4, 5. So about almost 5 p.m. Pacific time, which is about 8 a.m. Eastern time. You had plenty of time to go short and short the Dow. Now the Dow went down from 17,395 all the way to 17,000. That's a 395 point drop. Now we're going to go over that because that is something that most of you don't really understand and why it happens. So we're going to go over the indicators to get that going. Yeah, the ginger works. Thank you. So what we've done to make life easier for you is we created a template in the market analyzer, which shows you when the trade is in congestion, the way it is here. It's between the power dots and the trend stop. When there is a wide bar, and a wide bar is usually a magenta looking bar where they put a tremendous amount of volume in the market, and we will go over that. The Phoenix power dots. These are the power dots. When the power dots form, they're telling you three things that you need to be paying attention to in the market. They're telling you that there is volume, momentum, and liquidity coming into the market. Now, if there is volume, momentum, and liquidity coming into the market, guess what? That means that there's a trade opportunity that you need to be paying attention to. And when that happens, make no mistake, what they're doing is that they're rebalancing their positions before they go directional, before they go in a specific direction. So at the end of the day, the only thing that should matter is when they appear and how long they appear for. And once that happens, that pretty much will give you a very good idea of how strong the trade will be. Now, price of congestion basically is the congestion dots, or in this case, what I call the trend stop. And this is an ATR that we use, and it's very, very unique on how we use it, because it keeps us in the trade, but more importantly is that we're even out before the trade actually breaks it. So, and the way we forecast the exits, the same way that we forecast the entries. It's very unique from that perspective. So bear with. So now let's go over the indicators. I think it's important. So again, these are the power dots. This is our main algorithm, and it does three things. Very important things that you need to remember. It announces when there is volume, momentum, and liquidity coming into the market. And if you can understand that when we come out, there is hardly no volume in the market, and I mean no volume. And that's the uniqueness of our technology, that we're able to forecast and see opportunities that others miss, we don't. And so that's why we're able to forecast trades an hour, sometimes 2-3 hours in advance if you're doing intraday trading. Now, the dots in between the candles, these are trend dots. And if they're red, of course, they're bearish. If they're turquoise, they're bullish. Same with the trend stop, and these are plus signs, as you can see as I expand it. They are plus signs, so this is a trend stop. This keeps you in the trade once it goes directional. Unless it's broken or unless you miss your exit, it still serves as a good exit strategy. These little magenta peak dots, these are pivots, and you better pay attention to them because they're very critical to our analysis. What happens is that even before they form, they've already formed previously. So it allows you to see in higher time frames, or in the same time frame for that matter, where this trade is going. Now I only have 5 days of data here, and normally I like to have at least 35 days. So let's go to 35. So when we look at the previous, you can find that before it went down, these pivots were here, they were here, they were here, they were here, they were here, and they were here. So they do announce the levels that the trade is going to be taken to, and that's the power behind them. That you're actually able to map out your trade based on how directional the trade goes and how much drive, momentum, and liquidity goes into it. So no one would have ever anticipated or expected yesterday that the Dow was going to drop 395 points. I think that's a little bit above and beyond the norm. And for the first day of trading, I think it's a very exciting day of trading. Now, if you were like me, you missed it because it's a Sunday. It's the last day of vacation before we begin a brand new year, brand new week, which we are happy to do so. So the question is there any potential trade at this particular moment? The answer is no. It has already occurred. It occurred yesterday evening at around 8:30 in the afternoon. You got the signal at literally at 3:20 p.m. Pacific, which is 6:20 p.m. Eastern time. And then from there, it went all the way almost to, this would be 5:30, 6:30, so this would be 3, 4, 5, 5:30 in the afternoon, which is 8:30 p.m. Eastern time. So you had from basically 5:20 to 8:20. That's 3 hours. A 3-hour window telling you that this was going to go short. And it did. Now, let's go over what the dashes signify. Because the dashes are very interesting in between the candles. And what they announce is the actual order flow footprint without the numbers. And the reason why I have more than one is because it shows you the point of control where the buyers prefer to buy at and the point of control where the sellers prefer to sell at. Now that's something that you couldn't see before, which is very unique and very interesting. And I say that because we could never really pinpoint inside the candle. We could pinpoint where the candle opened, where it closed, and where it's gone. But we could never pinpoint where the actual price for the buyers was where they would prefer to buy, and where the actual price of the sellers was where they prefer to sell. Now they buy and sell in between the candle, make no mistake. But there's a specific price level in the candle where they prefer to offset most of their orders. And that actually gives you a clue, because it gives you the real footprint of the trade inside the candle, which makes it a lot more unique than ever. So what we're giving you here, and the only time that you should really be paying attention to the volume price identifier, which is these dashes, is when the power dots form. That's the only time that you should pay attention. And why do I say that? Because, for instance, what it's telling you, besides the volume, and we're going to go over the volume real quickly, is the intent. Now here, for instance, as it was going up, this was somewhat deceiving because they were really trying to get people to go long. Even though this came and announced short, consider a short. Now the fact that they took this long and the fact that it didn't pop here or here, but instead pulled away, is significant, but we can't see the volume divergence here. And so that's where the volume indicator comes in. And this is the granddaddy of them all, because this is the one that actually gives you the numerical value that you can count on. Now give it a minute, because it's going to take about that. Okay, so it came out a little bit faster than we expected, and that's not a bad thing. All right, so this is our volume indicator. Now, as you can see, it is apparent that there is no volume. Well, there is volume. There is nothing is price action. And the bars basically derive themselves based on price action, but the way we look at volume is from a whole other level. This is where we take it to the next level. Now, for instance, here in the first power dot, you can see the amount of orders that were in the buy, the amount of orders that were in the sell, and the net, the cumulative volume. Now, let's say that, for instance, we're looking at this from the millions perspective, okay, dollar value. So there were $95 million worth of orders here, $119 million on the sell side here, a difference of 24 negative. Now, for being negative, it didn't really do much, did it? But now you can see how volume is derived in the candle. And the reason why they kept it within 2 ticks of a difference is because there wasn't enough liquidity to drive it. But plenty of volume to offset in there, but not liquidity. And liquidity is also defined by how price action is derived. Here, this one had a little bit too much liquidity, too much volume, and too much momentum. Look at the difference. You had $400 million worth of orders, $242 million on the negative, a difference of $158 million. This thing moved, but it never went above this price level. Why? Because they were setting it up. And that's okay. That's a good thing, because when this little dot appears here, that's when you pay attention. And you got to give it at least 3 to 4. And the reason why at the beginning of the day you give it 3 to 4, because you want to see what the next move is. Now, in this case, you had two things that should have been concerned. You had the trend dots going up. They hadn't flatlined. You had the trend stop also indicating long. Well, each time that they came down short, as you can see, each bearish bar, in this case, the one right after the first one, had bullish volume. Now that's a very strong statement, and very few people can actually claim it. I'm one of them. This thing had $35 million worth of orders, positive orders on the buy side, 21 million on the negative, a difference of 14. So this is a bearish bar with bullish volume. Normally we would expect the next bar to be bullish, but with such light liquidity, very difficult. Now this one came in very aggressively. 11 million on the buy, 98 million on the sell, difference of 87 million. This thing should have gone through the floor, and it didn't. This was a good indicator, but this was even more. The fact that it came down, and the fact that the point of control, this dash, is all the way at the top of the bar, the way it was here previously, says that you only got one more candle left that's bearish, and then it's going to go bullish. Why? Because the minute this appears, if you see two candles that show consistency where there is an imbalance, and what do I mean by imbalance? And pay attention, because this is where it gets tricky. An imbalance in the candle is when it's a bearish candle, but the point of control of the buyers is at the very top, and what they are announcing is that they are not going to let that trade continue to go in that direction, because eventually they're going to step in to stop it. Now that is a very, very unique way of looking at the market. From this point on, you will never look at the market the same way again, because everything that you're going to learn today, which I love to cover 4 days of training that I normally give people that buy the software from me, but I can't. In an hour and a half to 2 hours, there's only so much information that I can give you. But hopefully it'll be enough information that it will make you look at the market differently from here on. And the reason I say this is that this indicator that you see here makes a huge difference, because this one will tell you the minute you have this type of consistency, and this is right after the first candle. Now, another reason why this didn't, this also is an imbalance is because you see how the sellers are at the top and the buyers are at the bottom. That's also an imbalance. Why? Because the sellers should be at the bottom and the buyers should be either in the middle or at the top or together, the way they are here or here, as you can see. That wasn't the case. So this showed an imbalance, and then this one really showed the imbalance. So normally you get two candles. The minute this happens, you see this, then you go 1, 2, and then the next one is bullish. Now what's wrong with this candle? And this candle actually confirms it. This candle shows that there's 91 million on the buy, 64 million on the sell, difference of 27 million in bullish orders. So that means that this bearish candle, because that's what it is, it's a bearish candle. Let's expand this a little further so you can see that. This is a bearish candle with bullish volume. Now, what do you see? Point of control number 1 in this candle is at the top. Point of control number 2 is at the top. And then the third candle, which is the last one that will be bearish, is point of control number 3, where not only did the buyers announce that they were going to take control, but the sellers conceded. And see, this is where a lot of people do not understand or cannot wrap their head around the fact that the banks do communicate with each other with how they report their order flow. So yes, what we are showing you here is the real footprint where everyone else is wrong. Now, why do I say everyone else is wrong? Because everyone else's talks about order flow and footprint are wrong, because they show you this nonsense. And let's go there. I want you to see it for yourself. There is nothing like comparing information. No, that's not it. Let's go back to just order flow. No, flow, not flowers. Okay, so let's go to images. Now, this is what everyone is trying to sell you, order flow, where they show you how many buy orders, how many sell orders are in, and that's not what this is about. In reality, each bar is different. Why? Because what they're giving you here is the average in each bar as to where the buyers and sellers offset the total amount of orders. Well, that's just an average. That's nothing different than a moving average. And they're wrong. Because in reality, see, here it is. The highest amount of orders that the buyers did versus the sellers did versus the highest amount of orders that the buyers did. This is wrong. From every level that you look at it, they're giving you an average. That's not where the point of control is for the buyers, and that's not where the point of control is for the sellers. And that's why a lot of people that use this technology, which is the wrong formula, and let me repeat, the wrong formula, the wrong algorithm, lose. Because they are not showing you how the banks are actually communicating with each other when they're driving a trade, or market makers. We are. And that's what makes a difference. See, for instance, see how this trade came down, and you see how the buyers were announcing that they were eventually going to come in and take control. Well, this in itself should have given you a clue. Now, why would I have not gone bullish in this trade, even though it did go bullish? The answer to that question is very simple. I didn't have power dots. Now, I could have taken this trade bullish, but I would have known that the minute it hit the trend stop, it would not have continued. Why? Because it bounced right back from it. But yes, the opportunity to take a small trade, which is not really small. We're talking about a trade that went from 17,257 to 17,294. Well, that's about 40 points. If that's a small trade, I'll take it any day. However, knowing and assessing the risk that you're going to take in a trade like this is what I call an 80-20. That means that 80% probability that you will win, 20% probability that it will go against you. This one is 99.9999% probability it goes in your favor. Why? Because it has every component. It's showing you that they have to rebalance their order book. It shows you the imbalance in the candles before they actually drive the trade. And the order flow in the candles confirms it. Now, that in itself is a statement. Now, why would I have gone short here after this thing popped as aggressive as it did? And you can see the amount of orders there. 135 million on the buy, 111 million on the sell. It was a bearish candle with bullish volume. But more importantly is that the bulls couldn't take it above this price level. See, for instance here, see how there's excessive orders on the positive side, on the bullish side? Well, those are limit orders. And those are limit orders that did not get filled because they were never going to get filled. This is what the market makers and banks do, or at least their algorithms, because now you're really trading mostly against robots than individuals. You see, they've digitized the world of trading, which is not a problem. I just want to know the playing field that I'm in. And if I can understand the playing field that I'm in, then I can create technology around it and counter-program what they've done. See, you have to understand that in 2008, after the subprime mortgage explosion that almost derailed the U.S. economy, the banks came to a discovery. We'll call it a moment of enlightenment for their stupidity, which was that they didn't have any risk-averse strategies that would protect them against tremendous losses. So since they didn't have that, they had huge losses. The amount of losses that would break a country, and in some cases did in that week and a half, or make millionaires, one or the other. Well, in this case, what they did in 2009 is that they changed their whole programming. Their whole directive and narrative at that point was to create technology that would protect them against adverse movements. Now, I'm using terms that some of you may not know or may not understand it, and that's okay. These adverse movements are these aggressive trades. And so, for instance, in Forex, if a trade goes against if there are 5 pairs that move simultaneously, more than 500 pips at the same time, all trading ceases, stops. And that's what happened, last year, January, February of last year, when the Swiss National Bank came out and said that they were no longer supporting the euro with the Swiss franc. And then suddenly you had 4,000 pip moves in all euro pairs. And it destroyed hedge funds. It destroyed Forex dealers. It was a bloodbath of no other. Yet they were still able to stop trading. Why? Because it did stop for about 3 to 4 hours. No quotes. And so that's what they've done. Now, in the futures market, they haven't taken those type of actions yet, but they have. And so that's why they've created now robots to trade. So what we did is that since I saw the change coming and I saw it when it happened, we began to reverse engineer their whole protocol. And that's what we've created. We've reverse engineered their whole protocol to give you the insight that as a retail trader you would never get access to. And so that makes a difference. So yes, volume is a main component of our narrative when we trade, but it is the only component that many retail traders are missing because they cannot seem to understand it because they've never been exposed to it. See, you've been exposed to moving averages, you've been exposed to MACD, you've been exposed to RSI, to stochastic, you've been exposed to Elliott wave, and all those indicators have been counter-programmed. Now, some of the moving averages now are working with the market because they were caught cheating, manipulating the market. Now, if you do not see how they report their orders that this is cheating, then you have an issue. Because if I see a candle like this, where the orders are 465 million on the buy, 777 million on the sell, there's a difference of 312 million negative, then you know what we call that? We call that in the market spoofing. That's a term where basically they're throwing in excessive amount of orders to try and confuse the trader. Well, here we're able to see because here live in the market, we can see, look at how many orders this thing is pushing at this particular moment. There is no other place than this one right here where you have it in the thousands, or in this case, you could say in the billions. Well, I mean, they're throwing the kitchen sink at this. And look at how that candle is moving. I mean, seriously? Does that make any sense? Look at the volume bar. The volume bar here is telling you that there is so much inconsistency in the direction of this market that it just doesn't make sense. Now, again, why would I prefer this trade going short over this trade, which ain't going anywhere? Because this announced short here. It didn't announce it here, and it didn't announce it here. I would have never seen this thing coming down here. I would have seen this announcing long, and it did, but I would have never seen this here. But my trade would have been the one to the downside here. Why? Because at every level, it was announcing, even with the volume. See, look at the volume here. You had 285 on the buy, 286 on the sell, difference of $1 million in orders, negative. And look at what they did here. I mean, perfectly balanced. Then this next one, 386 on the buy, 278 on the sell, difference of 108 million, and it didn't break above any further. Then this one, 827 on the buy, 679 on the sell, difference of 148. You know, again, bullish, excessive bullish orders that were quoted above this price level. Whenever the power dots form, they are, and they have excessive orders. They have orders that are being bid up here, up here, up here, up here, up here, and they want to see if the sellers are going to offset them and sell them at that higher price, because if so, that means that they take control. But when the sellers do not offset those orders, that means that they are going to take control and take it down. So this candle, I mean, they literally threw the kitchen sink at this. Look at this. The amount of volume that is here right now, and this is based on the open. Make no mistake, you know, the market opened here, but this is based on the open. The amount of order flow is based on how the cash market just opened right now in the Dow. So the futures, you can see everything, which is nice. So that means that people are scrambling, and you can see how they're trying to buy this market, but the sellers are just selling this market aggressively. And I mean aggressively. There is no tomorrow for the bulls right now. Tomorrow has passed. Now, based on this, I would look for volume divergence, but I'm not getting in a trade. And what do I mean by volume divergence? Whenever you see a bar that spikes like this, you're looking for the next bar to open up here at the 50% line, at the zero line. The dashes here signify where they settled at. So in this case, see how the number is at 921, 920 right here? That's based on, or 930, that's based on where it's at. See at the very top here, how these are the bullish orders, these are the bearish orders. Well, it really gives you a good idea of how bad the market is right now. And it's bad. Now let's go over the fundamentals for this, because I think it's very important to understand this type of move. And I want, you know, for the first day of the year, I did want to go over the indicators with you in a much more thorough fashion, so you can have a better understanding of what's happening. But now, let's take a look at why this happened. What are the fundamentals that came behind it? And let's go to the market. Well, let's look at the news that came out, and let's see if this affected it. So for Monday, or for Sunday afternoon actually, we had Australian news. The IG Manufacturing Index came out less than expected. Previous wasn't forecasted. You had a member of the Federal Reserve come out and speak. You had final manufacturing, producer manufacturing index numbers, producer manufacturing index numbers for China, which were negative, which is not a good sign. You had Monday, commodity prices year on year, which came out actually worse than before. German preliminary CPI numbers, core production index. This came out negative, you know, less than expected, much less than expected. Spanish PMI came at more or less the same, Manufacturing for the Swiss PMI came in better than expected. Italian PMI came in better than expected. French PMI came out as expected. German PMI as expected. Euro in general PMI better than expected. UK producer manufacturing index numbers came in less than expected, negative. Net lending to individuals came in better than expected for the UK. Money supply came in less than expected. Mortgage approvals came in as expected. And right now, we just had this news release, which was RBC manufacturing PMI for Canada. And this number came in less than expected, and we're looking at US PMI manufacturing index numbers coming up within the next 6 minutes. But this isn't what drove this market. What drove this market was that the tension between Saudi Arabia and Iran over the execution of a Shia cleric. Because the Iranians in Tehran decided to go and attack the Saudi embassy, which is not a really civilized thing to do. However, I can understand where their anger came from. You just killed one of their religious leaders. So, of course, tensions will be high. But that's a fight between them. However, it's a fight that has affected everyone else. Why? Because now you have tension in the Middle East, the potential of war, based on a lot of other factors, and religion being one of the most important ones. So everyone, and I mean everyone, took a hit in that one. If it's not the Dow, it's the DAX. And give it a minute, because of the volume indicator, you'll see that as soon as the DAX opened, it collapsed. I mean, there was no question about this. Now, granted, this line that you have here represents power dots in a higher time frame, and I mean very high. We're talking a 300 or a 240-minute level. So that's a 4-hour level here. Look at the open when this thing, it collapsed. I mean, there was no question about it. It just dumped, and then it never looked back. So at the open, there was a gap. That's significant. A 200-point gap, I'm concerned. So yes, when everything starts to go negative, you have to wonder, what are the reasons behind it? Now, this year is going to be very unique because the technicals are going to tell you one thing, and then the fundamentals are going to come in and finish driving it. The one thing that we have over everyone else is that we're able to technically look at the market from a very metallic perspective and say, okay, here's a trade opportunity. And it's one of interest because the market makers, or banks, however you wish to call them, have already made decisions on how they're going to drive the trade. That's a strong statement to make, because who decides how the market goes? We thought the retail market was in control of this. Really? Is that what you thought? Well, then you can continue to think that way, because when the Dow is down 365 points and the S&P is down 40 points, there is something wrong with that picture. So this is the S&P. You got the same signal at the beginning of the trading day to go short. Not only did it tell you go short, it screamed it, go short. If you went long here, then it's because you didn't have our indicators, our technology, to tell you go short, because it collapsed. Now the fundamentals, if you see that there are high tensions in the Middle East, make no mistake, it's going to affect the stock market. There is no forgiveness in that regard. Just like right now, there was a re-entry this morning at 8:30 a.m. Eastern Time, which is about 5:30 a.m. Pacific time, my time. Look at this. It's gone down from 2003 to 1992. That's a huge move. I mean, and it's continuing. This isn't over. Remember, I told you that this bar alone was a very dangerous bar in the Dow. Look at the amount of orders here. I'll put it right on top of it so you can see it. Look at this. I mean, they threw the kitchen sink at this, everything they had to try and hold it, and they couldn't hold it. Let's just go over a simple number. 52,865 buy orders, 61,239 negative orders. Difference of 8,374 on the negative. Well, of course, that amount of negative volume is going to tell you that the next one's going to be. Now, granted, these are limit orders that didn't get filled by the buyers. But you had the power dots up here telling you, go short. Not, go, did you have power dots here? No. There was no reason for you to even consider going long, here or here. The trend stop is here, but the power dots are up here. And this is still bearish. So now we have the market literally collapsing before our very eyes. And there is nothing that they can do about it. S&P is down 43 points right now. 43. That is a very serious number. From the open. 43 points. I mean, that hurts. And right now, I mean, this thing just dumped. You got the NASDAQ down 121 points. The Dow down 386 points. I mean, if that doesn't scream turmoil, I don't know what does. So let's remove the volume indicator because otherwise it's going to slow us down and we're not going to be able to look at other markets. So let's give it a second and we'll go from there. Any questions so far? No questions, really? I'm shocked. I'm surprised. So, would you have taken this trade? All day long. Would you have taken this trade? I would have thrown the kitchen sink and borrowed my mother's and my grandmother's at this one. I didn't expect the market to move as aggressively as it did. So let's take a look at crude because everyone wants to know about crude. Crude is a monster ready to explode in people's faces because now there is tension in the market and no one really knows how crude's going to react. So let's take a look at this market because it's going to define the way that we trade forever. This market is on fire. Now, with tensions high at the open, this thing spiked all the way to 38.33. Now, what do you see here? I see a little line. You know what that little line represents? That little line represents a 60-minute time frame, which has been guiding us for a very, 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 very long time. So let's go to the 60-minute in this case because I think it will be worth it. Now, the beautiful thing about trading is that there's so many ways to look at the trade. But this one right here, this is the granddaddy of them all. The power dots are very unique the way we use them because they map out support and resistance levels that they themselves have established. And when they establish them in higher time frames, you better respect them because they will. Now, you can see here, and let's go here. See here they have one which went from 35.37 all the way up to 38.34. It even surpassed here. But when it went below, it ripped for quite a few days. Well, now, same scenario, they're making a move. And they're making a move to 38.40. The question is, will it be enough to break above? Now, if we look at it on the higher time frame, and let's go high. Let's start from the 1440, which is the daily level, and work our way down. See, here we don't work our way up, we work our way down. We go to the higher time frames, and then we see in actuality what is happening in the market. So here, this level right here is a very dangerous level for them. Now, but you also have a trend stop right here. So that means that 38.49 or 38.50 is where it could stop if they make that move. Now, if not, they'll definitely make a move to 39 even. I'm thinking that right now, if tensions continue, we're definitely going to see it go to 39. And if it breaks above that, make no mistake, 39.50 will be where they hold it. And after that, it'll explode to 41. But right now, so long as it stays below 38, which is where our target is at, it's going to hold. If it does not break above that price level, it's coming right back down like a stone. And there is no forgiveness after that. Now let's go to the 720 minute. Excuse me. See right here? What do you have here? You have power dots on the 720. Now, that's a 12-hour time frame. But here's where it gets interesting, because now, see how they came down and see how they started to announce that they were going to go long? This is in the middle of the candle, and they have 1, 2, and then boom, they popped. Point of control in this candle is way up here versus this one. Now here, as you can see consistently, they're announcing that they're going to go short. And if it wasn't for the tensions between Saudi Arabia and Iran, we would have seen this thing go down instead of going up. So the fundamentals do come in and affect the market. However, they don't affect our perception of the market. That's the difference. So now we have a level here where we can actually change the color, actually eliminate this, and put a brand new level, making it much more important than the previous one, because this is a much more important level. And the reason why I say that is because it makes such a big, no, not a line. I need a ray, forgive me. We go with a ray, and we're going to put it right under it. And we have gold. Very nice. Okay, so now it is red. It is a 720. And that makes it dash dot dot. So now we have this level right here. Now, if they break this level, it's going to scream. Like I said, 39.50 is the next level. And they're coming at it really aggressively. So when they get to 38.31 or 38.37, that's when we have to really take a look at it. But right now, I'm not going short yet. And I'm not going long because it's about to hit a resistance level. And if it doesn't break it, it's coming down like a stone. So let's continue to drill down the numbers, because this one's going to be a very interesting one. And that's how we map out the trade. Now here, for instance, we do have power dots that formed here. And look at that, right at it. And so we are going to mark this one as well. And this one will be about right here. So this one is 35.77. And look, right at the money. I mean, they are pushing it. This one is bullish. Dash dot. This is dash dot dot. This is dash dot. That's how we differentiate. Now let's go to the 480. And look, it looks like they're going to break that level. $1.25. It's trading at 38.31. Oh, let's see if it holds. Whew. It's going to be an interesting morning. Is there a trade? The question is there a trade? I think there is one. All right, so this is about right here. And we're going to mark this one as well. And the reason why we're going to mark this one is because it's a very important price to them. If it's important to them, it's extremely important to us. dash. Let's go to the 300, see what that one looks like, and then the 240. Okay, so this is a 300, and we have a level right here. So if it goes above it, look where it's going to stop, 38.84. Now remember, it's got to break this level. If it breaks that level, then it's going to go through the roof. But if not, guess what? It's going to come right back. So this one right here, 38.84, is the one that's very important to us. And this one is a red, a 300. This one is a dot, and actually we'll go 4. The 240 and 300 are the same, are considered dots. See, this one here repeated itself. The fact that it repeated itself said consider long. Here, it showed up as a resistance level, but it's not a resistance level because you can see how they broke below it here. And now here they repeated the same thing, and they did use it as a resistance level previously, but it's actually a midpoint level. See how they broke through? Now guess what the next level is? Right up here, 38.83. So we're going to mark this one down, and this one is right about here. Yeah, that's the one right there. Now, why is this level significant, and why is this not a real support or resistance level? That's a good question, and I'm going to answer that for you. The reason why it's not is because, and this is a 300, so this will be a dot. The reason why it's not is because it is, in actuality, a level that just announces 3 things: volume, momentum, liquidity. And once they break through a level, like the way they did here, and maybe if we go back, no, there's no other level here, but you see how when they broke below this level here, it went aggressive, and then when they broke above it right here, it went aggressive to the upside, and then they did it again here, and then they really came down. Well, not a real support or resistance level, because every time they've hit this level, they've made drastic moves against it. Boom, down, boom, down. And so they either, when they break it, they move aggressively up here, or they move aggressively down. So this level isn't a real support level. This one is, and this one is. So let's go back to this. And you see how it didn't break above it? It just went above, pulled right back. So as we get into the smaller time frames, we're going to see a reversal in that regard. But this is a great example because you apply the same principles that you do to trading futures as you do to trading Forex, even stocks. Nothing changes. Now here, for instance, see how they use this level here? If you had this level on 300 and then this level on 240, you have multiple time frame confirmation telling you, go short, go short. Now here, this level here is one, again, that's shown that it's been breaking below and above, but hitting this level. So not a real support or resistance level, at least not used in that fashion. And we have to basically identify it as such. And so when no one ever said trading was easy. I didn't, but it is interesting. And when you know what you need to do, then guess what? At that point, that's when it became fascinating. Because now you can see what no one else can see. I'd rather see what no one else can see than be wondering what is everyone else trying to see. If anything, I think that is the lesson to be learned today. That we are not trying to guess, because we don't like guessing. And yet there is no absolute. But we don't like being misled either. And so long as we reduce that part of information, then everything else is a gift. So now let's go to the 180 and work our way down. We're almost there. Like I said, it's Monday. It's a beautiful thing. These are the type of things that make sense sometimes to do. So see here how they broke through this level and they went right through it. I'm not going to mark it because we already have this level, which is much more important. And this one, again, it's right in the middle of the range. Don't really need to mark it. It's insignificant because this is the range that they're trading in. But it's good to understand what they've been doing. Let's go to the 120. Every piece of information counts when it comes to volume. So here we don't have hardly any power dots except here, and again this was a level that they broke through. Would have been one that the minute they broke above it, boom, it exploded. Now look at, see how they came back. Oh, this is going to get really interesting as we continue to drill down. So let's go to the 90. We're almost where we should be, and I think we're going to be there right on time to actually find the trade that makes the most sense. So now, do we have anything here? No, nothing here. Let's see. No, nothing that we can use. Everything's mapped out there. So let us continue to the 60-minute. And so again, this is a mid-range level. Was it significant? Yes, it was actually. Very. Because number one, it's a level that repeated itself twice. Number two, they used it as a support level. And in this case, as a support and resistance level. It is a mid-range level, so this one's going to be hot pink. And it's a 60-minute, so it's a dash. It's a dash. And look at what we have here. Power dot. Ooh. What does that tell you? Short, not long. Now, here they announce short. Here they didn't. Here they didn't. But here, I'm paying attention to the power dot. I'm not, and it's trading above a level that I need to be paying attention to. So does that tell me that I should be considering going short? The answer is yes. So as an example, let's take this trade short. So we got in at 38.22. What is our exit if it were to go against us? Right here, 38.35. That is where you should get out. Now, the fact that this power dot formed on this hour candle and right below a 12-hour level, which used to be a 60-minute level, that you have multiple time frame confirmation telling you that this is a strong resistance level. Now they're going to play this game here, and it's going to be a very serious one, but one that you should not fear. See, fear is something that retail traders have and they can't overcome because they don't have all the information to assess risk, to determine, is this the right trade for me to take? Is this one that I should give great consideration to? And if so, how much risk am I taking? Because no one likes to lose big. I hate losing big. I despise taking a loss. You know, it affects my confidence level as well as yours. Imagine that. But I have to determine that sometimes there's a trade opportunity that I need to be considering. And in this case, you know, this is one of great consideration. Even though they've been bullish, you know, and coming in very strong, but you have multiple time frame confirmations. So what this tells me is that they could be trying to trick retail traders to go along when in actuality they're considering really coming right back down. Now they could come back down to 38 even. That's a 30-cent drop from where it's currently trading at. For me, it would be a 22-cent drop, which I'd be very happy taking away from them. So I have to look at it from that perspective. Now, granted, if this is on the 1 hour, imagine what we're going to find on the smaller time frames. So now we go to the 45-minute. And so now we're positive. Oh, imagine that. 4 ticks positive, 2 ticks positive. Again, this is the 45-minute. We don't have anything here on the 45-minute, but we do have a level right here. So we have to be patient and see where it goes from there. This ain't over yet. This is just starting. Now we're 8 ticks, 10 ticks positive, 11 ticks positive. Oh, this is going to be a very interesting trade. This is the one that's going to be a slap in your face type of one where it slaps them in the face. Yet all the retail traders went long when it hit that level. They were like, it's going to go to the moon, Johnny. They're going to go to 39.50. Is that right? Well, maybe you needed to have Phoenix Trading Strategies guide you in that trade to show you that nay, Jose, we're not going to 39.50, and it ain't today. So now you can see the power behind a 12-hour level and multiple time frame confirmation on the 1 hour, which was right up here, if you recall. I recall. You remember? I remember. I remember. If you don't remember, I remember. So now we're on the 20-minute. Is there anything significant that we should be looking at? Not really. No. No, there isn't. Not here, at least. Let's go down to a 15-minute. Very soon, we're going to see that there was even more confirmation on that level. I'm going to go down to the 5-minute because that's as low as I'm willing to go. Now, again, nothing here. Nothing in the immediate that would tell me that I should be paying attention to something new. Let's go down to a 10-minute. The Dow is down 404 points. Oh my God, someone cried today. But it wasn't us. So now we have it here. Let's see, is there anything? No, that 12-hour level is a strong level, isn't it? Now, here, right before it, of course, when it formed here, this is where the 1 hour formed. You see how in the small 10-minute, the point of control was here, not up here, the way it was up here, but it was here below. Whenever you see something like that, that means pay attention. This is inverted. The buyers are down here, the sellers are down here. Are you kidding me? And it's going long. This is telling you, pay attention, something doesn't make sense. And if it don't make sense, then it's short-lived. Let's continue. I love the 7-minute. Have you ever traded the 7-minute? If you haven't, take a note. It's a beautiful time frame. It's one that they love to trade. And I love to see them trade it. Now, when it gets here to 38.07, because it will, it's got to break through this aggressively and come down to 38 even. If it does not come below this level, then guess what? It's time to jump ship. Take what you can get and exit. Why? Why do I say that? The point of control in each candle should be giving you a hint consistently that the buyers are not happy that this trade is going short, and that means that they're going to want to take control of it. And they like to use these trend dots as support levels. Really deceitful individuals. And that's a kind word, because I have worse descriptions of them. But one must be professional, because we do not get emotional with a trade. We don't get, this isn't revenge trading. Okay, for those that are looking for revenge trading, exit the room and go find a psychologist or psychiatrist, because I'm not the one to be that. I'm not a psychologist. I'm not a psychiatrist. I'm a trader, and I teach you how to look at the market the way no one else will. Why? Because the type of information that we provide is numerical, It's digital, and it forecasts what no one else out there can. It gives you time to assess risk, entry, and even exit. So now we have a dilemma. It's bouncing off of this level. See how it came right to it? Now the buyers have conceded to buy at a lower price level. So let's see what happens here, because the sellers aren't even seen in this candle. This ain't over. It's just beginning. So now let's go to a 5-minute. I love seeing Bloomberg and CNBC because now they bring out every analyst out there, and oh my God, it's the end of the world. What are we going to do if tensions increase in the Middle East? How will that affect the markets? And of course, they all have their 2 cents. Oh, well, we have to do this and this and that and this, but they don't tell you where the trade's going. Oh, God, they're funny. Okay, so remember, since I told you it bounced off for this level, if it bounced, it was going to go. Well, it's time to exit. Come on down one more time, even if it's a break even. Really? See, I hate when they do this. They play this silly game. Now, remember, the trend stop was to the upside here. The trend dots were to the upside. The reversal was pretty strong because it was on a higher time frame. Expectations were that this thing would come down and collapse. Now, this could be a last attempt to test this level, which is 38.30, before they come down. So I also have to take that into consideration. That if this thing comes down again, and it looks like it just might come down in my favor one more time, I'm going to hold it and see. If it does come down again below where the candle actually opened, then I'm interested in staying, because that means that they have outplayed themselves and they're trying to just get the retail traders to go long when in actuality they're considering going short. So this ain't over. This is still a trade in play. What I don't like is, this is the reason why I'm going to exit, is I don't like that the trend dots, I got out with 1 tick positive when I should have got out with 10. That's okay though. Lesson learned. What I don't like is, see the trend dots? See how they've been using the trend dots here to actually make a move to the upside? That concerns me, because they did it here on the 7-minute, if you recall. So, and remember, and that's why I say the 7-minute is very crucial. But now let's go down to the 3-minute. I mean, if we're going to look, then let's look correctly. Don't you agree? So now here, for instance, they started to change directions and you're using it differently. However, the trend stop is flat lining almost. You see how it's starting to curve here? There's a small little curvature. I'm still not convinced, and I would never use it as such. But, and you can see this is why I hate when they do such things, because they suddenly decide to come right back down, and instead of me getting out with 1 tick, I would have gotten out with quite a few. So should we go back in is a question? No, the answer is no. The answer at this point is you stay still, you stand still, and you just watch and learn. So let's go to the 5-minute. And you see why I said no? Because they're still considering going long. Tensions must be increasing in the Middle East. So now, and you see how they used the trend dot, this trend dot right here, they came down and then they pushed up again. So, but here's where they hit the wall. So let's let them hit the wall again one more time and see how they react. Once you see how they react on this wall, then you know that it's over. But you see how every time they go up, they pull right back down. Let's look for something. let's look for volume divergence, and let's look at the volume indicator, because this is one of the lessons that is one of the most interesting ones that one cannot miss. See, we hadn't really looked at the volume because we were basing it off of the power dots, the volume price identifier, but now we can actually see, is there volume divergence? The answer is yes, and let me show you why. Take a line, draw it from here, go down. Now, why is this important? Because they threw the kitchen sink at this, and they've been pulling down. Now here, for instance, see how they stopped and then they started to reverse, and see how this was a big bar? I don't like that. So until the next bar comes and trades below it, I'm not going short at all. But now look at something. Let's look at volume. So here's where they made the mistake. They went long and they pulled back down. Look at how many bullish orders they had in excessive. 1,578 excessive bullish orders, which were limit orders, above 38.30 that didn't get filled. Then here, again, here this was a negative bar, only 75, practically perfectly offset. This one, negative 361, came down, pulled away from it. Then this one came in. This was a bullish bar with negative volume. What does that tell you? That tells you that the next bar is going to be bearish, not bullish. So what does that mean to us? As an example, again, we are going to go short at 38.20. And then suddenly we became positive. Why did I do such a thing? Well, let's talk about that. Whenever there is a strong resistance level, and you see how, number one, there's an increase in volume here because they threw the kitchen sink at this, and then it decreases, that tells you that the buyers aren't interested in continuing to trade above that level any further. Now here, for instance, they pulled back. The sellers said, no, we are not going to let you take this up any further. And then this one came in, and it had, positive volume, or it was a bullish candle with negative volume. That makes no sense. That is so off, it's not even funny. And then this one, of course, comes in with bullish volume. It's a bearish candle with bullish volume, but they pulled away. And you see how the volume has just been decreasing around this price level, 38.30. It's just been decreasing to the upside. Then that tells you that what their real intent is to try and get traders to go long, when in actuality they're going to reverse and go short. Now it may not be a big short, as we said previously, but it's going to be a very interesting one, because the markets in general are down. I mean, the Dow is down 364 points, the S&P is down 40 points, the Nasdaq is really hit the floor, and oil is up very slightly, $1 something, when it should have gone $5 to the moon, and it didn't. Does that make sense? So when I see that, I say to myself, this market should have reacted more aggressively, and it didn't. And so that's one of the things that you have to take into consideration, that this specific piece of information that just occurred here should give you, and the fact that you have two power dot levels here, a 12-hour and a 60-minute, and that this was a 60-minute previously, should tell you that you have multiple time frame confirmation assigning a specific resistance level that they have designated to trade around to rebalance their orders before actually going directional. Now, they already went directional. They went right to it. But now it's about rebalancing. And that means that they're not interested in going any higher than that because they have no reason at this moment to do so. Now, unless I hear a bomb go off in the Middle East, which I have not, all I've heard is tension. All I've heard is, how dare you? And the other one says, because I dare. And so it's just more of a, of two opponents basically taunting each other, but nothing more. Nothing more. And here it goes. Here it goes again. BBC comes out saying Saudi Arabia, Bahrain, and Sudan have severed diplomatic ties with Iran. The UAE is next, of course. And so, is it safe to say that they have not yet gone the extra mile? It is safe to say. And because of that, I don't see oil going any higher than 38, 35, where it's gone to. Instead, retracing and pulling right back down, probably 37.70. So, being that said and done, I think that we found our oil trade, and it isn't long. Any questions before we move on? No questions? Ready to move on? Okay, I'm ready to move on to FX. Or would you like to take a look at gold real quickly before we move on to foreign exchange? Okay, let's move on. So let us go to, we'll leave that trade on, come back to it later. Let's take a look at gold real quickly. Gold is always an interesting market. Okay, oil went up all the way to 1083, all the way from 1070, a $13 move, very respectable. Now it's trading at 1080. Is there a trade here? No, not to the upside any further, more to the downside if anything. That's a good sign. That would justify oil continuing to decline from 38.30. So if this is in the decline, then maybe we should take a look at the Swiss, the US Swiss, because that means that the dollar should get strong against it. There has to be a trade, always. Give it a second. It's the volume indicator, of course. Okay. US Swissy. So it did weaken against the dollar. Now it's apparently looking to strengthen. That's very strange, actually. Not something that I would have expected, but I like to look at, on the FX, you have to look at it on the higher time frames, 15, 10-minute on up. Smaller time frames are not as accurate sometimes. Too much noise. Okay. So it opened here, went up, came all the way down, and then it jumped from 99.30 all the way up to 10 to 100.5. Ooh, That's a big move the US dollar made. Recovery. So, where do we go from here is the next question. See, I don't have power dots here. That's a no-no. If I would have power dots, I'd say go short, but I don't. Here, when they appeared, they broke through it. And this is also a good example to look at, because when they came down, you could see the aggressiveness of the candles and the trend dots, as well as the trend stop. And you can see how they challenged it very aggressively, and every time the trend dots would form lower and lower, and then they just broke. And when they broke, you can see why. Previously, they broke through this level and it was very aggressively. So now, of course, I don't have a reason to go short from there, but actually before that, let me remove, although we do have volume divergence right here. This is interesting, but it came down too aggressively here, so I'm not sold on it yet. But let me remove the volume indicator so that we can move a little bit faster. Like I said, it's always interesting to see how the markets react. Okay. So let's look at this one from the higher time frame and work our way down. This one should be interesting. 1440. Ooh, here's one. China halted stock trading on Monday after weak manufacturing data spooked investors and sent shares plummeting. Benchmark Shanghai Composite went down 6.9%, while the Shenzhen Composite lost more than 8%. The trading halt was China's first ever use of circuit breakers, kind of emergency brake on its main exchanges. So you see what I mean? Do they like to lose? No. Because when they lose big. And so, of course, that is the reason why they have these new risk parameters where they control their loss when it's going to be big. That is significant. So you should be aware of how they play the game, because if you're aware, then you have no excuse to blame someone. Now, this is saying long, and they announced it 4 days ago. So if this comes out this far apart and I see a pivot and I see this come down, guess what I'm doing next? I'm going long, and I'm not apologizing for it, because I know that that's what they're going to do. Now, let's continue to drill it down. I'm not going to draw lines right now because I don't see the necessity to, but let's take a look at this because it's going to be interesting. Now we have power dots here up the gazoo. Now here, for instance, I'll draw this one. This would probably be the only one that I will draw right now. And the reason I say this is because that level is here, right here. Okay. So they broke through this level. This is red. So now, see how they broke through this level here? Now, until this closes, because it hasn't closed yet, if this comes right back down below 101.0037, then guess what? That means that they're going to consider going short. So right now, I'm going to just hold off on trading that because I don't see the need to. But that's a strong level right there. A very strong level for that matter. Let us continue. Let's go to the 480. $38.11. Oh my. Oil is at $38.10 right now. Go figure. Nothing here. Of course, that would give us a clue to continue the 300. Now this level's pretty strong. They went long, no question about it. I'm just not going to draw it right now. Let's go to 240. As we get closer to where it's trading, that's when it's going to become a little bit more interesting. Nothing here that we could use. Again, 12 hours is our main focus. Let's go to 180. Nope, nothing here. Now, would you have gone along here last week? Yes, the answer is yes. Yes, it told you go long. Don't apologize for it. And let's go to the 120. We're still working our way down the time frames. This told you to go long today. This was during the European session that this appeared on the 120. Should have been paying attention if you were trading the European session on the Swiss franc. The 120, the 180 are very significant. If you see power dots forming, that is something that you should really, really look at. Now, on the 90-minute, it's telling us short. So we'll mark this one because this one is significant. Again, it's trading very close to where all the action is, so it's very significant. So now you have multiple time frame confirmation. And this one is a different color. This one is crimson. Where is that? Crimson. Hold on. Where is that? Here. 390-minute dash. So now we have multiple time frame confirmations saying short. We're still not jumping into that trade. It's just telling us be aware. Now let's go to the 60-minute. And you can see how they went up, pulled right back down, but still no trade in sight, not yet. Let's continue to go down. Again, we're applying the same principles that we applied in futures. And there it is, right there. So, what is your risk if you take this trade from this point? 12 pips. That is your risk. Would I take this trade right now? I'd have to look and see if I would. Here it says no, here yes, and then boom. Yeah, as an example, I would take this trade here. What is my risk? My risk is 10 pips. Why? Because there's a specific price level up here that's identified in a higher time frame supporting this level, and that means that if price action breaks below 1.0036, guess what? It's going to come all the way down to this one. First, it's going to break 1.0028 and then to 1.008. That makes it a decent 30 pip trade, which I can live with. What is my risk? If it goes against me, 10 pips. If it goes in my favor, and that's why I say what we look for is we look to define risk. See, the one thing that you will learn trading with us is that we eliminate two major components from your decision process: fear and doubt. Because that is what stops you from trading. That is what stops you from winning. Because you don't understand what your risk parameters are. You have to know you're always going to be at risk when you take a trade. There's no way to look at it. You can't sugarcoat it. Anyone that tells you that you're going to win 100% of the time is lying and misleading you. You're going to win and you're going to lose. But with us, we hope that you're going to win more than what you lose. And that's usually been the case. Our winning trades outperform any of our losing trades, and our losing trades, we're usually stopped out. And what's our risk? 10, 15 pips. Now, take into consideration that if you are trading and you're in front of the computer, and there is volume, momentum, liquidity in the market, the brokerage firms or the forex dealers may not play games with you. I've had clients complain about a specific brokerage forex dealer that has been playing with them and stopping them out. And so, that is another issue that has to be addressed. But it's not because that they have taken bad trades. No, they've taken good trades. It's just been the forex dealer stop hunting them, which is different. So yes, my decision to go short is strong. My argument for that trade is strong. Would I take another position here? Not really. I'm not interested at this particular time of the moment. Again, risk has to be determined very aggressively before a trade is initiated or executed. And if you can understand that concept, then you're not going to have fear and doubt interfere with your decision process. It will make life and trading easier. Bottom line. So let's continue to scroll down. 30 minutes. Oh, but before we do that, let's take a look at crude. Let's go right back to crude because it looks like it collapsed. And yes, it did. What was our entry? 38.20. Where did it go down to? 37.82. So far, 38 tick trade, 39 tick trade, 40 ticks. Were we able to, to really define this trade better than anyone? Yes. The answer is yes. Were we able to determine our risk? Yes. Our entry? Yes. Our exit? Right down to the tick. See, it's not going to go below this level. At least I don't think so. And if it does, I'm not interested because at this point, we've proved our point. In one contract, $390 or the equivalent of 39 ticks. That's not bad. That's pretty good. So again, a 12-hour level, one that should be considered very, very highly. So now let's get back to our Swissy and let's continue on the Forex side. See, that's why I told you, don't ever go based on fundamentals or on them going higher and higher and higher. It may not be what they're looking for. Now here is where we should consider looking at volume. Let's look at volume because we may find something very interesting called volume divergence. Let's give it a minute. Okay. Now let's look at this objectively. Here and all the way here. Now I want you to think about this for a minute, and I will be right back. Okay, I'm back. So, you see our trade here? See how it's playing out? It's going to take time, but more than likely, it'll probably come down here to 1.0021, where it's at right now, 1.0038, where our entry is. So consider that, a 10 pip move to the downside. If it continues, it could be a 20 to 30 pip trade, but it's going to take time. Forex is a little different during the US session because there is less liquidity in the foreign exchange market versus the futures market. The commodities market get more active. So you have to be aware of that as well. But that's okay, because when you find certain trades like this that are trading around higher time frame levels, it makes sense to determine, how good of a trade it can be. But as you can see, we still have volume divergence right here. I mean, it's very clear. That's why I'm saying when you see something like this and you see that this is going up and this is going down, that should tell you something right away. That should tell you that volume is not in agreement with the direction of the trade. And if it's doing it around a specific price level where power dots have formed, and in this case we have two levels that have formed, then more reason to pay attention to that trade, because that trade is going to become a great opportunity. At the end of the day, we look for these opportunities. Minimize risk, a good entry, and removing fear and doubt from our decision process, because our expectations are very high that the decision that we've made to enter a trade is based off of low risk. See, I'm not saying there's no risk. Oh no, there is risk. Always risk. But if you minimize your risk in a trade, then the outcome can be very favorable. But if you don't understand support and resistance, and this is very important with our strategy, is that we determine support and resistance based on their order flow and how they relay it to us based on our technology. So hopefully you've been able to learn how we use all four components: volume price analysis, volume spread analysis, volume divergence, and order flow trading, the footprint. And if you've learned that, then hopefully, based on that one trade that we took today in oil, which was very significant because it was really the only trade that makes sense. We were too late to get involved in trading the E-minis because there was no trade. But crude was like a godsend because we were able to identify, and look, it continued to go down even lower. I got out here, but I would have probably picked up another 10 ticks on that trade. I got out with 39 ticks. I probably would have gotten out with 50. And now that it broke this level, guess what? It's got to come all the way down here to 37.10, 37.10, 37.11. So you're talking $1 move if it makes that trade. But first, it's got to go through here. See how this pivot is very significant? Then this one right here, 37.47, 37.31, and then finally 37.10. So if anything, I think that it's fair to say that volume is a significant component of trading. It's not just about support and resistance. It's not about moving averages because they're lagging and they're late. It's not about RSI, MACD, stochastic. Why? Because they have moving averages inside them. See, if you're using outdated indicators with outdated mathematical formulas behind them, you can't win. You're always going to lose. I don't like to lose. See, look at that. If I would have stayed in that trade, I would have picked up, my God, I would have gotten that. Let me see. My entry was here again at 38.20. It's trading at 37.47. Oh my, I would have picked up 60 cents on that trade. Equivalent of 600. Trading crude on a day where crude is the most dangerous trade to trade because there are high tensions in the Middle East. And with high tensions, what do we expect or anticipate? Oil to go through the roof. Oil should have broken to $40, not pulled back from 38.37 all the way down to 37.44. It's practically down almost $1 from the high of the day. So yes, we do things a lot differently than everyone else. For the first day of the new year, I'm very pleased with our result so far. Can't really complain. Should have stayed in the trade a little longer, but you know what? Sometimes it's better to take a good trade off the table. There's always another one that will present itself. Don't let greed be a defining factor in your trade, because if you do, you'll end up losing and giving up more than you should. So that's pretty much all that I have to show you guys for today. I hope that for the first day of the year, we continue to have success. For those of you that are signed up for the European session, we will be having the European session this Thursday from 2 a.m. to 4 a.m. And for everyone else, we will see you Friday morning, 9 a.m. Eastern Time. Thank you very much for joining us here today at Phoenix Trading Strategies. We look forward to seeing you again. Have a great one. Bye-bye now.